So let's take a look at some asset classes that have done well, and the question is, what do we have to look for? So now we're going to look at the real estate side of things. So we're going to look at both what we do in the US and Canada, and then on the development side. So this is a portfolio. We have a partner in the US called Venterra, and we bought with them this apartment for $31 million in 2007, 738 units in 3 buildings. And their job was to do a value-add strategy, to basically upgrade the units and the property itself, increase the rents, and see where that would take us over a time frame, which in this case is 8 years. So it just recently sold for $57.5 million, which was an IRR of 18% a year. The point here is that what made this work is what they brought to the table to make the asset perform better. It wasn't simply buying the asset and putting it in a box and just hoping that as a result of collecting rents, we would get all of the long-term returns we wanted. Work had to be done to create the return. Currently, we have a portfolio that we just did with a firm in Tawasin named the Century Group. There are 4 retirement homes. We've bought a 50% interest in these homes. They generate a very good cash-on-cash return to us of a little more than 7% a year. We have a very good operator, which we're happy with. We're looking at we hope, a conservative long-term IRR of around 11% a year. Again, here the issue is we have an operator that really understands the nature of how to run these homes. And finally, we have a new fund, which is a riskier fund, and it isn't ideally suited to everybody. It's a development fund. And in there, this is a particular property that we acquired. This fund is new. It actually didn't officially open until a year ago, January. So we acquired this property for $7.3 million in partnership with PC Urban. We have an 80% interest in the building. It's 33,000 square feet. It's been upgraded. Basically, it's below market rents. $2 million was spent on renovations. It was then released. A new top floor was put on as well. And the sale is closing in May of 2016. So this is a relatively short-term transaction. Most of the transactions in this pool will be anywhere from 2 years to 4 years, and not very long. And the IRR here, we hope and expect it to be in excess of 30% a year net fees. So while it's a more aggressive pool, it's also one that allows us to look at potential. So all 3 of these pools have something that in common, which is value has to be added in each case.